So today we're going to look at how you can mix ETFs and stocks and do it the right way. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero. How are you doing, Vero?
I'm doing good, Mike. As we publish this episode, I will be about to come back to Quebec from a nice trip in Europe with my family. So I guess I might be tired, actually.
I love to project yourself in the future. I mean, on the 30th, we're like two-thirds done with our trip in Peru. We're in Cusco on that day, but flying to Lima the next morning for the last length of our trip. So yeah, definitely the following week is going to be like, oh my God, the vacation's already over. What's
Right.
happening? But anyway, it's got a feeling every single time. I'm already thinking about my next trip and I'm not even done this one yet. So anyways, this is how it goes, right? I think it's a dependence. It's not even a hobby or a passion anymore. I think I'm like travel dependent. I don't know if there's like the TAs, the travel anonym or something, but I'll need to create that group at one point.
Oh my God, that would be so funny. So, Mike, let's go back to investing, right?
Yeah, we still have to make money to fund those traveling.
So many investors combine multiple strategies in their portfolios, and one of the most common combos is ETFs and stocks. But in such a case, how do you analyze your portfolio? Like, how does it make your life easier or maybe more complicated? So, these are some of the questions that we will answer today.
Yeah, we're going to try to make this parallel between investing in stocks and investing in ETFs. And as we go through the podcast, we're going to mix them together and see if it's a good mix, if it's a good strategy, or actually there is a good way to do it. But you're going to wait until the end of the show to know more about that.
So, Mike, let's start by describing the main difference between individual dividend stocks and ETF.
Yeah, so if you are new to investing or new to this podcast, actually, probably that's your best bet is to start with ETFs. ETFs are great because it's the perfect combo of diversification, low fees, great package managed by professionals, and you don't have to do much about it. So it's a perfect place if you don't really want to control what you own and you don't want to spend too much time on your portfolio. That could work. Now, inside the world of ETFs, and we're going to open a few doors today, but you can go for index. So investing in something that tracks the S&P 500, the TSX 60, that could be emerging markets, whatever you want. So that's like the
Mhm.
classic broad ETF. You could also go for specific sectors. If you have like a specific idea, you would like to invest in military and defense stocks, for example, because all the major countries now will be forced to invest more in their military budget, but you don't know which company to invest. Well, then there are ETFs that could help you doing that. So you can go by sectors or by ideas. And finally, you have a whole long list of ETFs that goes about strategies. So you could actually invest in an ETF that focus on dividend growth investing. That could be almost like similar. We could probably find something that looks like a DSR ETF maybe. That could be as simple as dividend growth investing. That could be factor investing, momentum, something geared towards technical analysis, or you can go more complex like covered call ETFs using leverage and more complex strategies. So as you can see here, you can go like super simple to super complicated. And just to add to the mix, now you have ETFs of ETFs. Like that's the whole shebang. So now you get like a long list of ETFs that are packaged into one single sticker. And actually, it's a good thing. We call that like you have like many all-in-one ETFs. So you can buy one ETF that covers them all. Once again, professionally managed, not too much of fees. So There's a lot of great stuff to ETFs, but as you can see, it's more like you have more than a choice among like 5 ETFs. It's more like 5,000 or something like that. So it's kind of crazy, and there are like new ETFs almost every day that comes out.
Hmm.
On
Hmm.
the stock side now, well, then you have again different strategies. You can focus on value stocks, you can focus on dividend growth, dividend yield, that could be penny stocks. Again, plenty of different strategies. It will, of course, require a bit more time, a bit more knowledge, and a bit more interest. So, those are like the three key things you need to manage your portfolio with companies inside them: time, knowledge, and interest. You can use a website that will support you in that journey, such as Dividend Stocks Rock. This is what we do. We provide that kind of support. So we provide the frameworks of like having a buying strategy, having a selling strategy, how to manage your portfolio, some educational content. So really what you need is some time and interest, because the knowledge will come. But again, it requires you to be more involved in your portfolio. And it's
Hmm.
actually what I love most about this strategy is you have full control. You know exactly what you own, why you own it. You can do all the trades that you want. You are in full control. And I'm all about investing with conviction. A lot of people ask me, but Mike, why don't you include ETFs in your portfolios? Or you could have like a section at DSR or create an entire service about ETFs. And I'm like, well, if I had to transform my portfolio and invest into ETFs, I would just literally buy XCQT and chill. Like that's an all-in-one ETF. Gives you like exposure to international market, Canadian market, US market. It's 100% equity. There you go. Like I would not spend much time for that. So the website, the service will be literally like 5 minute webinar telling you the difference between all the all-in-one ETF that goes from like conservative to aggressive in terms of asset allocation. And then you pick the one that suits you, you put it in a box, and you forget. That's, I mean, that's pretty much the essence in my mind of ETF investing. And of course, today we're going to
Right.
go a lot further than that because a lot of investors are doing something a lot more complicated. But for me, that would be it. And I would be super happy with that.
All right, so now this means the process for analyzing those different assets, whether it's for buying, selling, or just reviewing, it will also be different. So at Dividend Stocks Rock, we base our analysis on the dividend triangle. What is it? And give us an example of how you use it.
Yeah, so speaking of like having a website that gives you support to analyze stocks, we have created this framework that is super easy to understand but covers so much at the same time. Dividend triangle is for like the three most important metric that create that triangle. So looking at revenue trends, so the more you sell, the more the company's driving. Earnings per share trends, so you want to make sure that you're selling stuff but you're also making money and be profitable. And
Mhm.
eventually, if you're growing your sales and you're growing your profit, well, the dividend will come into play. So you're going to get dividend growth. So it's really the analysis of the trend for revenue, earnings per share, and dividend over the past 5 and 10 years. So when you have a business like Dolorama, for example, that shows actually double digit revenue growth, earnings growth, dividend growth year after year after year, well, I'm not surprised that the stock is performing well. I mean, it's kind of like just the basic when you think about it is, would you like to invest in a company that keeps selling more stuff to more people, making more money and giving you more dividends? Of course you
Of
want that
course.
in your portfolio. I mean, it's so simple, right? But at the same time, this tool will also help you analyze what's going wrong when you see revenue that will stagnate or go down, earnings per share peaks or drops. Same thing with the dividend trend. A company that shows a 5% dividend growth trend for like 5 years and then goes down to three and then goes down to one and then goes down to zero. Well, probably that the revenues are slowing down, earnings are slowing down, and something's wrong in the business. So it's going to give you the
Mhm.
signal to dig a little bit further and then review your investment thesis and determine if you should keep it or not. So, in a nutshell, you can start with a dividend triangle, and then you're going to either have confirmation that you have a good investment thesis, or you're going to have more questions, and then you dig a little bit further to see what's going on and what's the context around bad numbers.
But then, can someone use the dividend triangle for ETFs? And if not, what metrics could investors use?
I wish, but it's a lot more complicated than that because ETFs are investing in multiple companies, right? Regardless
Right.
of the type of ETF, you do not have like one single stock in it. So you don't have revenue or earnings per share, or I mean, you have distribution metrics. But then again, even a company that focuses on dividend growth stocks will grow its dividend, but not in a same way than a company where you're going to really have like kind of like this escalator. Like every year it goes up a little bit. Now in this case it could like variate up and down a little bit, and then like with strong peak and then a little bit drops, so it's not as clear for the ETF. So
Hmm.
instead you have to do a completely new framework to go through an ETF to determine if it's the right fit or not. So the first thing I like to do is to go on the ETF website because you have tons of information over there, and you start with the prospectus and the fact sheet. The first thing I look at is the strategy. I need to understand what's the strategy behind that ETF and what does it do. If you don't understand how it invests and you cannot explain it to a 12-year-old, go home. So many people, they are not able to explain what is the strategy, how the ETF will generate returns, or how the ETF will generate their distribution. And if they end up saying, oh, it's too complicated, or you wouldn't understand, well, there you go. You have like the signal that you don't know what you're talking about. And you're
Right.
just hoping that you picked a good ETF that may be trendy, but you don't know what you're doing here. Once you understand the strategy, then you can look at the ETF allocation. That could be like their top holdings in terms of stocks. So looking at the list, determining if those companies sounds good to you or not. It could be geographic, so you see the top countries. It could be by sector, so you have all those information on the ETF website, and then you have a global picture of what the ETF is doing, where it's investing. So now you feel more comfortable with that strategy. Then you can look at fees, because of course, if you look for a dividend growth ETF, you're going to find like each ETF manufacturers will have one. So you may have to compare like a dozens of ETF together. And between the strategy and the top holdings, another differentiation would be the fees. Another one would be the asset under management. Smaller funds may at one point be discontinued. So you want something that is popular enough for the firm to keep going. And also the volume. So you have like a lot of liquidity. There's no spread. So because if not, if you buy and sell, sometimes you're going to have like some arbitrage there as well. So all of those things needs to be considered before you buy an ETF. So as you can see, as nothing really related to the dividend triangle or analyzing a stock, is a completely different ballgame.
Right. So going back to stocks, you would look at the narrative or all the reasons why you like a company, right?
Yeah, so you want to build an investment thesis. And the investment thesis is really those reasons why you like a business, why you have it in your portfolio. That's the fundamental behind knowing what you own and why you own it. So you need the story, the narrative, like what's you like about the company in general. You can after that define it, and we talked about that not too long ago about how to craft a good investment thesis. That should have the playbook. So the playbook is literally the explanation to a 12-year-old of what the business does to generate income. Then the growth vectors, so how the company will be able to grow its business. So grow the dividend triangle, so revenue, earnings, and dividend going forward, and the economic moat, or if you prefer, the competitive advantages. Like what's special about this business that its competitor is having a hard time to get or to compete with. So I mean, for example, you can think of Apple. Well, nobody sells an iPhone. So a lot of companies will sell smartphones, but they're not the same brand. They're not the iconic recognition that we have with an iPhone. So it is a part of those economic modes. So it is a
Hmm.
protection against competitors. So you need all of that. And of course, this is one other thing that we do at Dividend Stocks Rock is we have like more than 400 stocks where we discuss those playbook, growth vectors, economic modes to make it easier for you to understand. But it comes down to that point. If you just buy a stock because you watch that on YouTube or you listen to a podcast and you're just like, yeah, those people sounds interesting and smart and they talked about that company, so we're going to buy it. That's not enough. You need your own reason because you can borrow someone else's ideas, but you cannot borrow his conviction. So you need to find your own reason why to own a stock.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. All right, so like you said, 2 weeks ago, we did an episode on how to craft an investment thesis. I will put the link in the show notes at thedividendguyblog.com/238. So, Mike, you've just mentioned what's a complete investment thesis, narrative, playbook, there's economic mode. This, of course, does not apply to a mix of assets because ETFs are composed of hundreds, sometimes thousands of stocks. How would you complete your investment thesis or the narrative for an ETF?
Well, fortunately, you can still have a narrative for the ETF, but it will be linked to the strategy instead. So the qualitative aspect is going to look a lot like kind of like the playbook, the growth vectors, not really the economic modes, but you can really imagine, like I said with the narrative about the military defense earlier in the introduction, if you want to make a play on a specific idea, going for an ETF would make a lot of sense. You want to make a play on electric vehicles, you want to make a play on the rise of artificial intelligence, you have ETFs that will make those plays for you, and you will save a lot of time researching dozens or hundreds or sometimes thousands of companies. So the narrative will not be as strong as you have, and the conviction will not be as strong as you have for a stock because you have the opportunity to dig into more numbers. But you can apply that thinking, okay, so what would be the idea of like investing in an ETF that tracks the S&P 500? While the narrative is the S&P 500 is one of the most known index in the world, one of the most performing index in the world as well for the past decades. So it makes only sense. I mean, even Warren Buffett says, if you don't know anything about investing, you buy the S&P 500 and then you forget about the rest. So here's your narrative here. So you do have kind of like an investment thesis behind an ETF, and that's relatively easy to craft.
Then would come like the bear case of each of our stocks, including business vulnerabilities, industry and market threats, and also a competitive landscape. So pretty hard to pull them up for an ETF, right? Like, what would you do instead?
Yeah, again, it's really hard to focus on that part. The point is really to understand the strategy behind the ETF and determine what could go wrong with that strategy. So for the S&P 500, for example, well, it's cyclical, of course. Right now, it's heavily exposed to the Magnificent Seven. So if the Magnificent Seven goes wrong, well, then your investment in the S&P 500 will go down as well. That's totally normal. For covered call ETFs, for example, a lot of people will think, well, since they're writing a covered call on assets, they will do great during bear market because you have the premium that you get from selling the option. But the thing is, that protection is diminished, it's reduced because there will be less demand for options when the market goes down, because investors will not be super excited about buying stocks, let alone buying call options. So when you're still going to get a premium, chances are the premium is going to be a little bit lower. So those are like technical things that if you don't understand, you will just see the result at one point because now the situation happens, and then you will be just like, well, my covered call ETF is not performing as I thought it would. Well, that's not because it's a bad product, it's just because it's a bad understanding of how the product works. You'll find also more information if you go for more classic ETF. a good starting point would be to look at the top holdings. If you have like a few companies that has a huge impact, because sometimes if you look at like sector ETFs, I'm thinking about the communication sector, for example, most of the time you will have like 10, 15, 20% weight into Meta or Alphabet, Google. So then you know that yes, you're covering the communication sector, but if you thought that you were buying all the ATs and AT&Ts, Verizon or Telus and Rogers, you're actually buying a lot more Meta and Alphabet than anything else. So that could like make you realize that what you thought you were buying is not exactly what you just got in your portfolio.
Hmm.
So looking at a little bit deeper analysis of the ETF, how it works, what it holds, will tell you a little bit more about the downside, the bear case of the ETF.
So at dividendstocksrock.com, we recommend reviewing your portfolio quarterly and taking action yearly as needed. Do you think the same is necessary for other types of assets like ETFs?
Well, I really think that you should monitor your portfolio regardless of how it's invested every quarter. The point is really to make sure that everything that you have in your portfolio is still aligned with your strategy and does what it is supposed to be doing. So it could be stocks, could be ETF, it could be bonds. That doesn't really matter. Of course, the process will be a lot faster if you have ETFs because you're not going to review all the top holdings every single time. You just want to make sure
Mhm.
that they respect the same strategy, that everything is on par, on target, and then you're good. But again, quarterly review, yearly review, super important in type in terms of investing. Unless you are like super active and you want to buy and sell ETFs like a trading strategy, that would defeat the purpose of being like a passive investor, of course. But I know investors that are looking at their ETF every single day and trying to make trades. So that's another way to do it. I would find that very time consuming though.
So, in the end, Mike, an investor needs a process for each of its asset types in the portfolio, right? So, how would you do it?
So for ETF, actually, super simple, right? You buy one all-in-one ETF and then you're done. So that would be my process. And by doing this, I would save me a lot of time because my quarterly review would literally last 2 minutes, just going back on the ETF website, making sure everything is under control, and then closing the ETF website and go on with my life. That would be the way I would do it. You can actually mix ETF and stocks. That is a process that could be a bit more demanding, but could be super interesting because then you can use the mix of ETF and stocks as an investment role and having your own strategy. So you can decide that you have a core of ETF, maybe let's say 50 or 75% of your portfolio is in an all in one ETF or a broad ETF. And then you have the rest of like the 25, 50%, whatever, into stocks. So it's kind of like you have your basic recipe for your soup and then you're adding different flavors to it. So, which
Mm.
totally makes sense. You need to make sure that you don't create overlap too much with the big holdings in the ETF versus the stock that you own. That's particularly true if you're doing this on the Canadian side, because if you're looking at the TSX 60 ETF that will follow pretty much the Canadian market versus ETF that focus on dividend payers or any other types, you're going to see a lot of overlap. And it's not that complicated to figure out that if you focus on dividend that has a relatively high yield, you're going to end up with banks, utilities, telcos, and pipelines. That's kind of obvious. So I'm not too sure how much you need an ETF plus stocks if you do that part. What is also interesting is to use ETF for a specific strategy or geographic exposure. I know a lot of investors, they want to do the research for Canadian stocks because they feel comfortable with them. They're more familiar with those as well. And they also want to have exposure to either international market or US market. So then you can invest in a US ETF that will cover the S&P 500 and just focus on Canadian stocks on the other side. So that's a great way to avoid overlap, get a good diversification, and not having to spend too much time looking into stocks because a part of it will be handled by professionals.
Okay, but Mike, I may be biased here, but to me, mixing both sounds like more confusion, more noise, and uncertainty. Does it for you as well?
I guess it depends on how you see it, right? A lot of investors will argue back that Analyzing 30, 35 stocks, monitoring those every quarter, looking at quarterly earnings. Sometimes I have to dig into investors' presentation and earnings calls. Could add more confusion, noise, and uncertainty, as you mentioned. So that it
Mm,
goes both ways. As a disciplined investor, you should create your investment strategy and then stick to it, right? So, as I said earlier, if I buy an all in one ETF or if I build a portfolio of like 4 or 5 ETF that I rebalance once a year, that actually gives a lot of clarity and not much confusion. So that could go very, very well. But then again, a lot of people keeps on changing their ETF and then changing their allocation, and they're not that passive. And this is where I get your point. You can get confused. And I also met with a lot of investors and they have like 3 ETFs that are literally doing exactly the same thing. They just have like different names. And they're just like, yeah,
right.
I did not know which one to pick. So I picked 3 of them. And I'm like, okay, but you just bought like 1 potato, 2 potatoes, 3 potatoes. So I hope that you like potatoes because this is the only thing that you have in your fridge. You have no other vegetables. It's just all about potatoes. Mind you, if you want to make a good poutine, well, you need a lot of potatoes. So maybe that's good. I don't know. I'm gonna continue with the food analogy because I'm a foodie, so you have to respect that. It's like seasoning mix. You have like those like pre-packaged mix of
Hmm.
spices that you can have. So if you're about to cook a steak, will you put like 10 different seasoning mixes on your steak or just one would be enough? My guess would be one would be enough, but I don't
Yeah,
know. I'm not the kind of person who's gonna make a crust of seasoning
sure.
mixes on the steak. You're gonna kill the flavor and you're gonna kill the steak at one point. So I think that right now, as the world of ETFs is expanding every single day with more new strategies, new products, new mixes of everything. I mean, it's kind of funny because right now the big rave is all covered called ETF, but first covered called ETF started like in 2012 or something. And it's been more than a decade. But now they added like a lot of the other things. They had some leverage and they focus like on companies that are thriving. So it's completely different than the original covered call ETFs. And again, not saying they're good or bad. I'm just saying like it's evolving all the time. Now you have
Mm,
several ETFs that will offer you exposure to cryptocurrencies. And then you have leverage ETFs on both sides. Like so you have like extreme bullish ETFs using you like twice or 3 times the returns, or on the other side, you can buy like short ETFs. Anyways, it goes on and on and on. And this is what creates the confusion is the choice.
right.
It started as something super simple and then it got so complicated. I mean, it reminds me of like the other day we were trying to watch a show on the TV and now it gets complicated. Before that, we had like a cable bundle, right? So you open the
Hmm.
TV, you have like 152 channels, you watch 5 channels, but at least you can watch whatever you want. Today, you open your TV, actually you don't even have like a cable or anything. You just like have an Apple TV or whatever, and then you just like wonder, okay, is this show on Prime or is it on Paramount or is it on HBO? Do we still have our Crave or Disney Plus subscription active? So it used to be simple, you just
Right.
watch Netflix. But then now you have like Netflix plus a dozens of other subscription that you cancel and resubscribe depending on the show you want to see. Well, you could transform your portfolio like this with ETFs or with stocks. It's also the same thing. I keep saying that if you get like 75 stocks, it's like buying an ETF altogether, but that is not going to simplify your investment process either. So it's really important to take a moment, sit down, and determine in what you want to invest. And you
Hmm.
probably notice, I don't know if you notice, listeners, but I never mentioned once stock returns or ETF returns in this show. It's been 30 minutes that we're talking right now, and I have never tell you, oh, you should look at ETF returns to select the right one. First, because you're looking at the past, not at the future. And second, you have no clue why one ETF has greatly performed versus another. And that has to be put into context. And then it's just easy to play Monday morning quarterback. So don't fall in the trap into investing in an ETF with great returns. I seen the same movie with investors back then when I was a financial planner. Sometimes they came in my office and say, oh, I want to buy this fund. And I'm like, okay, why? And I'm like, well, because this fund has outperformed the index over the past 5 years. I'm like, well, all right. But I mean, maybe it's not going to happen for the next 25 years. Who knows? So if you don't even know
Right.
what the fund is about or the ETF is about, it's probably not the right strategy to apply to your portfolio.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Okay, so in summary, Mike, what would you say to those who invest in ETFs and dividend stocks, thinking it makes for a better portfolio?
Well, I see a case with the example of having a core portfolio with satellite stocks around it. So definitely that works. If you want to go for a specific sector or specific strategy for a portion of your portfolio with ETFs, that works too. So the only thing is it will require you a little bit more, like building an Excel spreadsheet or something like that to track your sector and asset allocation maybe. So it's going to be a bit more complicated with that strategy, but it could also limit. I mean, if you spend like an hour or two to build that Excel spreadsheet, after that you're good. While if you manage just stocks, you will need to spend that hour or two every quarter, not just once. So I can
Mhm.
understand on both sides how it works and what's the appeal of going with a core plus satellite stocks or just stocks only. Again, it's a matter of like understanding what you're doing, not having overlap, understanding the strategies, and knowing what's going to happen with your portfolio in a bear market.
And by the way, listeners, we're not here to tell you a strategy is better than another. They all work, but consistency is what pays the best, right, Mike?
Yeah, I think the debate between the strategies and the work, I mean, it's just futile. It's not going to end up with anything. We're going to always have like hardcore ETF investors and hardcore stocks investors, and that's totally fine. But most stock studies on stock investing, sorry, will show you that the average retail investors lag the stock market by a wide margin. In other words, if you're a retail investor, a DIY investor, you fail most of the time and you should probably just buy an index. But the reason is, it's not because we are bad investors. It's because most investors are not able to stick to strategy for a long time. And that is true. And that is being repeated all the time. Even for index investors, I mean, they're going to try to time it. They're going to try to get in, get out, while the real thing would be I buy the S&P 500 and that's it. Yeah, that was like a pause because there's nothing else to do. You buy the index and then it's over. Don't try to like mix it, like go in, get out. I mean, that could be a hobby, but that's not an investing strategy. That's completely different.
Mhm.
So if you stick to a strategy, I mean, I've been a dividend growth investor since 2010. It's been 15 years now, and it has worked beautifully, but I haven't changed a thing. Yes, I tweaked a few things, but the essence of my strategy back in 2010 is exactly the same as today. So I can tell you already, in 15 years from now, I'll be close to 60 and I will still be a dividend growth investor because I like the strategy. I have high level of conviction in it. I feel good about it, and feeling good about your investment strategy is more important than anything else. Because I also
Mhm.
feel good about it when the stock market is down 25%. I don't even blink. I'm like, yeah, that's cool. I know the companies I own. I know that they're going to go through that crisis and they're going to survive and thrive. So if you're an ETF investor and you're listening to this, you must have this level of conviction in your strategy and then you'll be good. But don't try to shift from one sector or one idea or one strategy for another every year. then you're just adding a pile of work and you're not necessarily going to create value out of that.
Well, that was such an interesting discussion, Mike. Thank you so much. Listeners, you can make strategies if you feel comfortable with them, but remember that simplicity and consistency offer the best yield. To create a sustainable dividend income, enter your name and email at thedividendguyblog.com/income to download the Dividend Income for Life guide. For our show notes and related content, visit thedividendguyblog.com/238. Don't leave just yet. Thank us by hitting pause and the subscribe button underneath our podcast logo. And until next week, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.